There are moments when the market feels like a vast, bewildering forest, a dense canopy of conflicting headlines, a tangled undergrowth of advice, and the constant fear of taking a wrong turn, stumbling into unforeseen traps. Have you felt that quiet ache, that yearning for a compass that points not to the loudest voice, but to the true north of value? It is a familiar pain, this struggle to discern genuine signal from the ceaseless market noise, to build a fortress of wealth when the ground beneath your feet feels constantly shifting, when the very ground you stand on seems to betray your trust. Perhaps you've experienced the sting of a market downturn, the confusion of contradictory expert opinions, or the frustration of seeing others succeed while your own path feels obscured. This isn't just about making money, it's about reclaiming agency, about transforming that anxiety into the serene confidence of genuine understanding. It's about building a financial life that feels sturdy, resilient, and deeply aligned with your own wisdom, rather than swayed by every passing gust. For too long, many of us have navigated these woods with only a dim lantern, relying on intuition or conventional maps that often lead astray. But beneath the surface, beneath the daily drama, there are fundamental forces at play, like the unseen roots of ancient trees, holding the forest floor firm. These are the factors in factor investing. They are the persistent, data-driven drivers of returns, often hidden in plain sight, waiting to be understood. This calls to mind the profound patience of Benjamin Graham, who taught that the true investor looks beyond the fleeting popularity of a stock, seeking its intrinsic worth, its deep-seated value. He understood that market noise often obscures the underlying economic reality, and Warren Buffett, his most famous student, has shown us again and again the power of discerning these underlying realities, these persistent advantages, through meticulous analysis and a steadfast refusal to be swayed by the crowd. Think of it like tuning a finely crafted instrument. Most investors only hear the general melody, but a master understands the individual strings, the resonance of the wood, the subtle interplay that creates harmony. Factor investing is about understanding those individual strings, those fundamental elements that compose the market's symphony. It offers a framework to move beyond the superficial, to build a portfolio with the quiet confidence of one who understands the very heartbeat of the market. Today, we will gently pull back the veil on 6 such hidden strategies within factor investing. We will move beyond superficial narratives and into the quiet strength of data, offering you not just information, but a framework for truly informed decisions, for building sustainable wealth that resonates with truth. Are you ready to look beyond the headlines and truly understand the why behind the market's movements? Many of us have been told the market is perfectly rational, instantly pricing every piece of information. This comforting notion of an efficient market, where beating averages is mere luck, often clashes with our deeper observations. If the market were truly flawless, how do we explain the persistent, almost rhythmic patterns that emerge year after year? This is where the market's blind spots appear, creating opportunities for those who look beyond the surface. The data, when we allow it to speak, tells a more intricate story. It reveals that certain company characteristics, factors, have consistently delivered superior returns. This isn't random, it stems from underlying economic realities and, crucially, human nature. Benjamin Graham's Mr. Market, with his emotional swings, illustrates how collective fear and greed create systemic mispricings. Our own cognitive biases anchoring to past prices, the sting of loss aversion, overreacting to news are not just personal quirks, they are threads in the market's fabric, weaving patterns that factors like value and momentum are designed to systematically untangle and exploit. It's a profound behavioral arbitrage, transforming the market's irrationality into a quiet, persistent edge, yet discernment is vital. Smart beta funds, while promising, sometimes repackage basic concepts without the robust implementation needed for genuine factor exposure. It is crucial to distinguish true, data-backed strategies from mere marketing hype. Always seek clear academic grounding, transparent construction rules, and a long history of empirical evidence. Consider the foundational factor of pure value, an architect's blueprint for discerning true worth. Graham taught us to seek assets selling for less than their intrinsic value, offering a margin of safety. This is a profound commitment to understanding a business, seeing its potential beyond the market's fickle gaze. Are we truly listening to the quiet whispers of the data, or are we still swayed by the market's loudest shouts? Beyond the familiar currents of value and momentum, the market holds other, often overlooked drivers. These are the silent forces working beneath the surface, revealing themselves to those who truly seek understanding. Have you considered the quiet strength of quality? It isn't just a subjective feeling, it is quantifiable. Superior profitability, low leverage, and stable earnings act as an economic moat, protecting a company's castle. These are the very durable competitive advantages Warren Buffett speaks of, systematically identified and exploited by discerning factor strategies, building resilience into your portfolio. Then there is the intriguing paradox of low volatility. We often assume higher risk must yield higher returns, yet the data often whispers a different truth. The low low-volume anomaly reveals that less risk can, surprisingly, mean more return over time. This phenomenon often leverages behavioral biases, such as investors' preference for lottery ticket stocks, those with high upside but also high risk. By systematically avoiding these, a low volatility strategy offers a counterintuitive path to enhanced, steadier returns, a calm harbor in stormy seas. The size premium, the historical outperformance of small-cap stocks, is another such driver, though its echo has faded in recent years. A critical reassessment shows us it's not a universal constant, but still a subtle force under specific conditions. Understanding these nuances helps us discern when this factor might still be a powerful, albeit quiet, contributor to returns. Further still, we find the unsung heroes of investment and profitability. Factors derived from a company's wise investment behavior, its capital allocation efficiency, and its robust profitability metrics offer independent sources of return. These are deeply rooted in fundamental analysis, reflecting sound capital management principles and providing a clear lens into a company's true health. Imagine crafting a multi-dimensional lens, integrating these diverse factors. This isn't about simply adding more assets. It's about weaving together orthogonal or uncorrelated drivers of return. This symbolic practice creates a more resilient and diversified portfolio, reducing idiosyncratic risk while enhancing systematic exposure to proven return drivers. Are you ready to see the market through this clearer, more sophisticated lens? We often trace market movements to economic data, but what truly stirs these currents beneath? It is the very pulse of human emotion, the quiet biases residing within us all, shaping collective action. Have you noticed how easily a narrative takes hold, how the crowd can march relentlessly towards a recent winner, amplifying its ascent? This is the echo of confirmation bias, a deep human tendency to seek out information that validates what we already believe, creating the persistent momentum effect. For the data-driven investor, understanding this herd instinct is key, not for joining, but for discerning when it creates a thoughtful, contrarian opportunity. Consider the profound weight of loss aversion, that visceral ache of parting with something, even a losing investment. This fear often prevents investors from selling declining assets or, conversely, from buying broken companies that are fundamentally sound but temporarily out of favor. Yet, it is precisely this human reluctance that creates hidden potential for value investors, allowing them to acquire mispriced assets. This is a core tenet of Benjamin Graham's wisdom, understanding that the market's emotional pain can be the discerning investor's quiet gain. Then there's the subtle trap of overconfidence, especially when faced with the glittering promise of innovation. Our eager embrace of disruptive technologies and captivating story stocks can lead to irrational exuberance and overvaluation. This often results in systematic underperformance for these high-growth, high-investment firms, quietly inverting the profitability and investment factors. It's a crucial reminder that a compelling narrative, however seductive, must always bow to the cold, hard truth of the data. The market can even tap into a dopamine feedback loop within us, the fleeting reward of quick, speculative gains. This neuroemotional pull can sabotage our disciplined, data-driven decision-making, leading to emotional attachment to losing investments or the premature abandonment of sound, long-term factor principles. It's a battle between instant gratification and enduring wisdom. But we are not merely victims of these biases. We can transform them into an edge. Imagine a three-step framework for systematically exploiting market psychology. First, identify the pervasive behavioral biases at play. Second, understand how these biases predictably distort asset prices. And third, strategically position your portfolio to benefit from others' irrationality. This isn't manipulation. It's a profound understanding of the human condition, allowing you to navigate the market with serene, data-driven wisdom. Are we truly aware of the emotional currents that sway our own investment decisions, or are we still sailing blind? Building a truly resilient portfolio is much like engineering a magnificent structure. It requires more than just piling bricks. It demands a deep understanding of the materials, their individual strengths, and how they interlock to withstand the test of time. This is the quant's workbench, where we begin to deconstruct the factor cube, strategically combining elements like value, momentum, quality, and low volatility. It's an exercise in creating a robust foundation that transcends the simple allocation of assets, a blueprint for true financial fortitude. The key lies in the orthogonality imperative, combining factors that move independently of each other. Think of it not merely as diversification, but as building a bridge where each support pillar stands strong even if another falters. This statistical independence is critical for genuine risk reduction and enhancing returns, moving beyond the superficial comfort of merely adding more stocks or asset classes. It's about understanding the deep, underlying mechanics, not just observing the surface. Once we have our factors, we must consider how to weight these engines within our portfolio. Should it be equal weight, allowing each factor an even voice, or or perhaps risk parity, where each factor contributes equally to the portfolio's overall risk profile? Or might a fundamental weighting scheme, aligning with the intrinsic values Benjamin Graham championed, be more appropriate? Each approach has its data-backed merits, suited for different market regimes and investor objectives, demanding a thoughtful, strategic allocation. And just as a finely tuned engine needs regular maintenance, a multi-factor portfolio requires disciplined rebalancing. This isn't a reactive measure, it's a proactive, three-step technique inspired by Graham's unwavering discipline to ensure consistent exposure to your desired factors. It prevents factor drift, that subtle erosion of your strategic alignment, keeping your portfolio on its intended course, steadfast against the market swings. For those ambitious investors yearning for true financial mastery, a powerful toolkit awaits. Practical recommendations for data providers, sophisticated screening tools, and analytical software empower you to independently build, backtest, and manage your own multi-factor strategies. This is your workbench, your space for quiet, data-driven creation. Are you ready to move beyond passively accepting market narratives and actively engineer your own financial destiny? Even the most meticulously crafted map has its hidden dangers, its shadows that can obscure the path. Factor investing, while powerful, is not immune to these. Have you considered what happens when a brilliant strategy becomes too widely known? This is the silent threat of factor crowding, where popularity can diminish a factor's premium. When too many hands reach for the same alpha, returns can shrink and correlations increase, revealing a hidden truth about market dynamics and the potential for factor decay. We must also be humble before the market's ever-shifting currents. The past, while instructive, is not a crystal ball. Regime shifts remind us that economic environments change, causing even robust factors to underperform for extended periods. To cling to past performance as a guarantee is to ignore the market's dynamic, living nature. It requires a deep, meditative awareness of the broader economic landscape, much like a seasoned sailor reads the changing winds. And in our pursuit of data, we must guard against the data mining trap. It is disturbingly easy to find spurious correlations in vast datasets, mistaking statistical noise for genuine premiums. This calls for rigorous quantitative analysis, a skeptical mind, and a three-step technique to discern robust evidence from mere data dredging. We must ask, is the factor economically intuitive? Is it persistent? Is it replicable? This disciplined questioning is our shield against illusion. Then there are the subtle, often overlooked costs, transaction costs, and implementation drag, bid-ask spreads, market impact, commissions. These seemingly small frictions can silently erode wealth over the long term, often missed in theoretical models. Minimizing these costs requires thoughtful execution, patience, and respect for the cumulative power of small leakages. Finally, even with sophisticated models and clear data, the human equation remains paramount. The story of Jesse Livermore, the legendary Great Bear of Wall Street, serves as a poignant reminder. His profound understanding of market mechanics was ultimately sabotaged by a lack of emotional control and discipline. Factor investing is not just a mathematical exercise. It is a profound test of discipline, patience, and the capacity to silence the ego. Are we truly disciplined enough to trust the data, or will our emotions still lead us astray? We have journeyed through the market's hidden currents, peeling back layers of complexity to reveal the profound power of factor strategies, from the persistent anomalies that expose the illusion of efficient markets to the silent drivers beyond value and momentum, and the human psychology that fuels these very premiums. We have sought not just information, but understanding. We've explored the quant's workbench, envisioning how to engineer a resilient multi-factor portfolio, and confronted the shadow side of factors, acknowledging their risks and limits. It is a path not for the faint of heart, but for those who yearn for a deeper truth, a more profound mastery. This journey echoes the timeless wisdom of Benjamin Graham, who taught us the enduring value of analytical rigor, the profound comfort of a margin of safety, and the quiet strength of independent thought. He understood that the market, in its moments of irrationality, often offers us gifts if only we possess the discipline and clarity to receive them. To truly navigate these waters, we must cultivate a mind that questions, a heart that remains steadfast, and a spirit that seeks evidence over popular opinion. This is the essence of his legacy, woven into the fabric of factor investing. To truly empower yourself means to transcend the ceaseless market noise, to gently set aside conventional advice that often serves many masters but rarely offers genuine insight. It means fostering a data-driven, critical, and confident mindset, a quiet sovereignty over your own financial destiny. This isn't about chasing fleeting gains. It's about building a fortress of sustainable wealth, brick by data-backed brick, with the serene assurance of one who understands the fundamental forces at play. So, let this be an invitation to continuous learning, to the disciplined application of these advanced insights, and to the relentless pursuit of true financial mastery. Transform this knowledge into actionable, profitable decisions, guided by data and grounded grounded in wisdom? Will you choose to simply observe the market's surface, or will you dive deep to truly master its hidden language?